Uganda's oil decade is a serious investor signal. It is not a shortcut around diligence. This PRINCEPS Group East Africa briefing explains what the World Bank's latest Uganda Public Finance Review means for an investor considering market entry or expansion, and the questions that should be answered before capital is committed. The review was published on the 29th of June 2026. It says oil revenues are expected to begin flowing from 2027 and could average around 2.2% of gross domestic product each year. But the report's central message is conditional. The opportunity will depend on fiscal discipline, stronger domestic revenue mobilization, better public investment quality, and productive spending that supports jobs and services. It is therefore a public finance signal. It is not a new investment license, a tax incentive, an approval route, or a promise of commercial demand. The wider fiscal context matters. The World Bank says roughly 650,000 Ugandans enter the labour market each year, while fewer than 68,000 formal jobs are created. Interest payments consume roughly one-third of tax revenues. Tax collection is below 13% of gross domestic product, compared with an East African regional average above 15%. The review also estimates that about one-third of every shilling invested in infrastructure is lost to inefficiency. These findings do not remove Uganda's opportunity. They show why an investor must understand how a project depends on public spending, infrastructure delivery, tax administration, and the wider payment system. Start with the demand case. Separate revenue that depends on government expenditure from revenue driven by private customers. Then identify any dependence on new roads, energy, logistics infrastructure, public procurement, or oil-adjacent activity. A single optimistic growth assumption is not enough. The base case should be tested against delayed procurement, slower infrastructure execution, exchange rate pressure, higher import costs, tax policy change, and longer customer payment periods. Next, examine the establishment pathway. The exact route depends on the proposed activity, ownership structure, location, and sector. Company incorporation and statutory registration are handled through the Uganda Registration Services Bureau. Tax identification and domestic tax registration sit with the Uganda Revenue Authority. The Uganda Investment Authority provides investment promotion and investment licensing guidance. Sector approvals, environmental obligations, land access, work permissions, customs treatment, and local content requirements must be checked with the competent authorities and professional advisors for the specific project. A general market insight cannot verify an entitlement to any license, incentive, exemption, land allocation, or public contract. Counterparty quality is the next gate. Identify who will pay, the strength of their balance sheet, the length of the payment chain, the enforceability of contracts, and the working capital required between delivery and receipt of cash. This is especially important where imported assets, foreign currency debt, or high fixed costs are involved. A profitable project on paper can still fail if receivables arrive late, or foreign exchange movements raise debt service and replenishment costs. The first 12 months deserve their own cash flow model. Include incorporation and licensing costs, premises, recruitment, professional advice, insurance, equipment, import taxes and duties where applicable, stock, mobilization, contingencies, and the realistic timing of customer receipts. Model a base, upside, and downside case. The downside should show how long the business can absorb delayed revenue, higher operating costs, or a slower route to approval without emergency refinancing. The practical output is a Uganda market entry decision brief. It should state the target activity, ownership structure, proposed legal form, capital expenditure, location, sector regulator, import needs, expected customers, licenses, tax registrations, land or premises route, counterparties, employment plan, financing currency, and first-year cash flow exposure. Every material point should either link to a current official source or be marked as an assumption requiring legal, tax, regulatory, technical, or financial confirmation. PRINCEPS Group East Africa helps investors turn that evidence into an executable entry plan. Our role can include market entry screening, investment readiness analysis, establishment pathway mapping, counterparty diligence, project economics review, implementation planning, and coordination with specialist advisors. PRINCEPS Group East Africa does not provide legal, tax, immigration, or regulated investment advice. and does not guarantee licenses, incentives, financing, returns, visas, public contracts, or approvals. The conclusion is straightforward. Uganda's oil decade may strengthen infrastructure, services, and private sector demand. The investable opportunity will belong to organizations that distinguish the headline from the cash flow, verify the route, test the counterparties, and sequence implementation before capital is committed. Read the full analysis at the PRINCEPS Group East Africa website, or contact the contact address shown on screen for a decision.